Hey, Dustin Tibbits here, financial advisor with jazzwealth.com. Hope you'll check us out. We love doing these videos for you to try to teach you a little bit something. And tonight, we're going to be sampling Old Buffalo Trace. It's a staple, right? Like Buffalo Trace. Probably one of my favorites, for the price anyways. Let us get this game started. And that was me pretending like I hadn't already sipped it before this. Just kidding. No, I'm not. Okay, so I want to this will probably be a multi-part video because I've got a lot of these to share. We got Sell in May and Go Away, September. We could cover all kinds of stuff. But today I want to cover a few market myths and show data behind it. Instead of just being that guy like, oh, you got to invest your money or whatever. What's the data? Let's see some of this fun stuff. So we're going to dive right into it. This may not be the longest video ever, so you might want to drink up. People talk about market timing as if it's a bad thing. Well, yeah, most people suck at it, right? It's just not possible. There are some investors, bigger name investors, that have a knack for it. Okay, fine. Well, I wanted to show you if you're thinking, ooh, I don't like the market here. It's a little bit volatile. Maybe I'll skip a few days and walk away. I want to show you the impact of that because it's really troubling here. So, and I'm going to be in the way. So let's go like this. Whoop. Get you out of the way there. Okay. What I'm showing is we're talking about the myth of market timing might help you make more returns. It's easy to believe that. Well, on this chart, I'm going to make it bigger and hopefully it doesn't get blurry for you, but let's just go like this. We're looking back to 1999. What I was trying to do was go 25 years on this. And we're saying, okay, there's a lot of lines here, but we're saying the S&P, if you've just invested in the S&P since 1999, your annualized returns will be 7.7%. There was a couple of really troubling time periods in there, and that's why the return is lower than the ultimate long-term average, which is about 9.9%. Over here, what we're showing is the starting or the final growth of $100,000 as your initial investment. And clearly, that's going to be the biggest winner, just the S&P. Well, using the S&P, that's your biggest winner, is just staying in. Then we said, okay, subtract the 10 best days over that 25-year time period. Look at the difference. It is literally, almost half your total return. You missed 10 days, right? 10 out of 25 years, you missed 10 days. So now you have 292,000, where this guy over here has got 638,000. You see where we're going with this? If you missed the 20 best days, you didn't beat inflation over the long run. If you missed 30 best days, you might as well have not even invested. You got a 0.5% annualized return. You should have just left it in a savings account. Missed the 40 days and 50 days, now you've got a negative return. You had 25 years and you left with less than you started with. Now, again, that's missing the best of those days, the best 10 days, the best 20 days, etc. Why is that? We did a class for clients. If you don't know, we're the advisors that we do classes and it's not wrapped around like basic stuff. It's like, let's get into some data here. Well, we did a class for clients where we said, well, why is it that if you miss the best 10 days, you end up with almost half the returns? And the reason is because the best days in the market come after the worst moves. Always. There is no other way about it, especially in that 25-year window. You will not have a trending market higher that then has one of its best days inside that window. It comes because the market sells off and fear is greater than greed. Remember, greed is a slow thing and fear is a quick thing. That's why they say the bulls take the stairs and the bears take the elevators. Well, the bears, right? Elevator goes faster than stairs. So missing the 10 best days, to not mislead you here, would involve you suffering some of the worst days. You know what I mean? Which becomes like, oh, well, that's why I like to contribute weekly, right? If you have a IRA with some other advisor or whatever it is, you want to contribute weekly. And we actually did a class for clients to show out of the entire life of the market, if you could pick a day and a time each week, what would be the best day and time? Is there an advantage one day or not? So there is. And the answer is you take your $100 a month that you invest and just split it into weekly instead. And then you'll be, much better off. The trouble is when the market starts selling off, what do you think? Oh, maybe I'm not going to invest in it. Maybe I'll just hold tight. Maybe I'll put it in cash for a day or two. Okay, now you see the impact that that has. When in reality, when you do weekly, and this is a little bit of a side lesson, but in reality, when you're used to doing $100 a month, let's say, and then you do 25 a week or whatever you decide, it'd be less than that. But instead, when the market's falling, you say, well, I'll just up my deposit and then I'll back it down when the markets start bouncing. You have more flexibility. Also, you're not chasing everybody else. What do you think everybody else does? They invest at the beginning of the month or the end of the month, and you're competing with that volume that's coming in there. That's why you tend to see that end of the month, especially end of the quarter, you see a little different market than you do on a Tuesday in the middle of the month. You know why? It's all you guys and mutual funds and stuff too. But you guys with your $100 a month, right? Oh, I'll just wait till the end of the month after I pay rent or mortgage or whatever you do. So be really careful about that. All right, second thing. Hey, fun one. What if you I got carried away. But what if you just missed the first day of the year? Whatever, and sometimes it's, January 1st is closed, but whatever January 2nd lands on, what if you missed the very first day of the year? And if it was a weekend, then we went January 3rd or 4th. Doesn't normally happen. So, okay, well, if you just invest in the S&P with the dividends, reinvesting, $638,000, of course, if you missed the first day of the month, it's not the biggest adjustment ever, but you ended up with less than $600,000. You had a 7.7% return. Now you got 7.39%. If you're in some kind of S&P mutual fund and they charged you a fraction of a percent or whatever, it'd be a little bit lower, of course. But wow, that's just missing the first day of the month. More importantly, see how it starts? You invested $100,000 over here, and I guess I can put myself back now, right? Let me get out of the way. Okay. You could see how it starts. Not that big of a deal as the years go on. That power of compounding starts to add up as the markets get carried away, especially after a big pullback and then there's a big rally. So now look at that spread. It widens out over the long term. That's just missing the very, very first day of the month. So a little bit of a fun one there. I was just, playing around with some different things. Let's go on to myth number 2. Kind of correlates with the first one. Holding cash might be a better opportunity during volatility. And I'm talking about not cash as in just sitting there. I'm talking about a money market fund. A lot of people, you know what I mean? Like in your 401k, you cannot have cash as a position. You can have a guaranteed fund or a money market fund. They might even call it a cash fund, but you can't just say put it all in cash. So here's what we did. Don't let this one scare you here. We'll start with the red line. This is the purchasing power of your dollar as the years go on. So again, we're going back to 92 here, and we're saying, okay, each year you basically lost 2.4% purchasing power of your dollar. In other words, you need to get that to offset inflation. Then we said, okay, what was inflation during that time period? 2.53%. And this is just the culmination of all of that. So it's the sum of all these 25 years. So 125% increase in inflation, right? Then we have the money market fund. I just chose the highest paying one at the time. And so you had this money market fund. Well, you normally could use a money market, over this time period, you could use a money market fund to offset inflation. You don't have that right now. And that's just because of the recent spike in inflation. So holding cash and having cash be the better play, especially over the long run, may feel a little bit better. But you know what I mean? It's not actually going to help you out there. Now, we can actually look at different investments here, just a side topic here. You take $100,000 and you say, well, let's just try a couple different things. If we're in the S&P, I'm not saying you need to be in the S&P, especially if you're getting close to retirement or whatever goal you have for the dollars that you have. But you can see it's a clear outperformer. Over that 25-year period, $100,000 turns into $2.58 million. I'm not talking about inflation at this point, just the total return in reinvesting dividends. Next best performer is the Russell 2000, at least with what we're showing here. The NASDAQ would be in there. It would actually outperform the S&P at this point. But we're using the Russell 2000 because small caps tend to be popular with the more aggressive investor. If you look at gold, 100,000 turns into 8.11 or 811,000 or 6.66% annualized returns. And then as you work your way down, you can kind of see how, man, if I'm in a money market fund, I have wasted my time. And I'm not saying you need to be all in one or the other. You know how you have, diversified portfolio. You might be diversified as you age or get closer to your goal. So I wanted to show some of the differences there. And again, we have the growth of the $100,000 up here and the annualized return going back to that time, 2020. It'd be, what would it be? It would be, 27 years, right? Including everything that's going on here. So careful there when you decide to have cash as an investment, it gets a little bit tricky. All right, let's go through. I don't know, I'll just keep going. I don't know, whatever. The old myth, investing is only for the rich. Well, I don't think that's a myth much more these days because we have fractional shares, we have accounts. They'll let you start with less. We actually do not force our clients to, hey, you got to have $1 million to work with or something like that. It's actually just 2,000. I'm going to get out of the way so you can see this. Okay, the chart. What we're showing is the S&P's total return. And then we're showing a 60-40 portfolio. This would be 60% stocks, 40% bonds, money markets, short-term bills, or cash, right? That's a 60-40 portfolio. Now, the blue line shows you putting in $50 a month. So here's your contribution rate relative to your return rates. So investing $50 a month, of course, is over 25 years is $15,000. If you invest in a 60-40 portfolio, you got $46,000, $684, $46,684. Okay, that's not bad if you're a little bit more risk averse, or maybe this is a portion of your portfolio where you didn't want to take that kind of risk. But in your aggressive portfolio, your $15,000 turned into $74,000. And the key here is it's $50 a month, right? And I'm a big advocate for what's that number supposed to be? I want to work out the plan first. Tell me what that number is. You should ask us or ask an advisor. Tell me what that number is. Why is it not $52 a month? How'd you come up with 50, right? You should be asking those questions because, well, if you're working with an advisor, they should be doing that work for you. I'm sorry, I just knocked the whole desk here and killed it. Okay, so that's that one there. Investing for the rich. We don't have to spend a lot of time on that. We know it's not so much these days, but people still say it. It's whatever. What I also hear is investing is like gambling. Oh, by the way, that previous slide, maybe share that with the kids. You know what I mean? The kid, you're like, hey, I'm trying to get my kid to invest here. They don't want to do it. It's $50 a month. Like, get over it. Get started, right? A little tough love there. I do hear investing is like gambling. Investing is not like gambling. Trading is like gambling. Now, I love trading, so I'm not knocking it. I understand the game that I'm playing. I get a kick out of it, and I happen to have a little knack for it, so it's fine. Investing is not like gambling, but how do we prove that to you? Well, craps. If you use the stats from like the Action Network, craps has about a 50% edge, right? Or probability of profit, however you want to say it. Blackjack, about 49%, right? Slot machines, just don't even bother. Right? Why? What do you don't even know what those things mean anyways. I watch people, me and Chris went to the Hard Rock, and these slot machines that have like 12 different rows and computers and buzzers, and you're like, how do you know if you won? There's not even any rules or anything. Just stop it with that. All right, so what we did to have some data here and go, well, is investing like gambling? We said, okay, let's take different windows and see what the probability of a negative return is. Now, let me start by saying, I'm not saying if you pick a random period along a 20-year time period that you would not have negative returns. I'm saying you started and then a 20-year period goes by, what's the probability of a negative return from the start, okay? So let's just get that out of the way. So we're gonna have a couple slides here. We did 20 years, 15 years. What we're looking at is the probability or the rate of probability of a negative return. In 100% of all periods over 20 years, you have a positive rate of return. Okay. Now you could be here, right, and have a negative decline, but you'd have a positive rate of return. So in a 20-year time period, that beats craps tables, does it not? Now, God, I get it. It's so much fun, though. I recently discovered craps. Chris took me one time, and then we took the whole office. I've literally done it twice, and what a game, right? Anyways, over a 15-year time period, you get the exact same thing. Now, the shorter time periods, you can have volatility. Right now would be a great example. The market's being volatile with what Trump is doing and the change in government and all this. Okay, fine. Over 10 years, we do have some moments where we could have some trouble. 92.3% of all periods still beats craps. Blackjack still beats betting on sports. right? Ooh, some of you are not going to like that. Over a 5-year period, you got 81.4% of all periods producing a positive return. Again, I'm not saying that you can't have a negative pullback. I'm saying negative return. Let's just stick on that. So investing is not like gambling. Trading is like gambling. And I have nothing against trading, but not with your life savings. You know what I mean? Let's go have some fun. That's like craps. You don't go to craps with your IRA. You know what I mean? You have a good time. Hopefully you make some money and you're on your way. So this is likely part of a series of videos we're going to do about investing myths. Like I said, we got a whole bunch of others that we could do, but I hope you enjoyed it, right? A real data-driven focus on some of these topics instead of saying, oh, just trust me. I don't know, whatever. Hey, we are ranked the 66th best advisor in all of the United States. There are 22,000, or maybe more now, 22,500 advisors. And we were ranked number 66 by USA Today. You can actually look it up. And no, we didn't pay for that. They just reached out to us. I hope you'll give us a shot. You can schedule a call. We're starting an account online, transfer an account. And we use Goldman Sachs. We never touch your money. So we have no chance of like, oh, Dustin, that's a nice shirt. Where'd you get the money to pay for that? We cannot touch your money. That's important to me. Anyways, we'll be back. Do this all over again. Enjoy the rest of your drink, and we'll see you next time.